Money podcast. China's economy expands more than expected ahead of the escalation in the US tariff war, but US investors express concern about its economy, and the Australian share market takes a bit of a breather today. We'll have the details in a few moments. Hi everyone, it is your daily 10-minute business and finance news wrap for this Wednesday, the 16th of April 2025. The Australian share market ended pretty much where it started today. The S&P ASX 200 down just 2.8 points at 7,758. That's even as US investors express a bit of a bearish sentiment following a Bank of America report, and as China's economy expands more than expected. For all of that and more, I spoke with Yu Li, Deputy Portfolio Manager at Blackmore Capital.
The ASX has been grinding up for a few days now, not by much today. It's been a bit quiet, but it's actually roughly up nearly 6% from the lows after what we now call a Liberation Day. But we're still not recovered to the announcement. So we're not back to the level before, April 2nd. And today, with the market, it's actually a bit of a mixed bag as well. So the market, the move is a mixed bag. The market is in the green, and that's actually being dragged down by energy, which is down nearly 3% today. The rest of the sectors are more or less muted or slightly up, but leading by the financials, positive performance. And that's benefited from the overnight, overnight result for Citigroup and Bank of America. And the strong results actually helped lift it up a little bit of the risk appetite. So that's been what's happening in the market today. It's fairly muted. I wouldn't call it an outright sentiment shift. I'd probably call it a repositioning. So the market is still right now balancing, what lies ahead, and nobody really knows what we're about to expect. I wouldn't say that this is a reflection of a confidence. I think this is a reflection of market recalibrating and their positioning.
So let's go into sentiment a bit more then. I saw an interesting survey from Bank of America overnight, which showed investor sentiment hit a 3-decade low, with many reducing their exposure to US equities as a result. What are your thoughts?
I think this level of bearishness, you're catching fund managers at a level where macro visibility is probably at an extremely low. And I think there isn't really much there for people to feel optimistic in terms of the macro. And I think, I'm not surprised that this is, such sentiment coming out. But I think, like you said, it is a sentiment, but not fundamental. I think the survey also touched on the asset allocation. And I think if you look at the cash level, it's not really at a level where we would typically call a, risk of full defensive environment. So I think what's going on is this is a repositioning on, balancing the fear and the hope. It's a lot of fear there for the short term, what's about to happen for the next 10 days, half a month. But also there's a hope there because I think structurally speaking, US is still a story of growth. It's still a story of liquidity and depth and innovation. So I think they're certainly hesitant in exiting that market. And now if I think about the broader context behind it, over the past few years, there's been a lot of optimism on US exceptionalism. There's been a lot of fund inflow into US from the rest of the world, including Australia, in equities. And there's been a lot of, optimism there. And I think it's not surprising that this is going back a little. So it's not a full vibe of exiting, but I think this is just a bit more balancing to what the level was before a few years ago.
If that's the US, what about China? What do you see as China's role in all of this, especially at a time where its GDP growth right now, at least backward looking because it's for the first quarter, better than expected because first quarter growth came in at 5.4% year on year in the 3 months to March. But this predates obviously any tariff issues, right? So how do you see all of that panning out?
Yeah, really glad you can see that this is more or less an expired number already. I think I call most of the data we have right now an expired because they expired. Generally data expire because it tells you what happened in the past, but particularly right now because they're about a world that's shifted meaningfully. But nevertheless, I think it gives you a sense of the starting point that the China is in to face this tariff escalation. We think about 5.4, it's definitely a solid number. But I think, if I zoom out decades in the past, the China story has been evolving for a while. In the past, we would see China growing at high single digit, double digit. We're not looking 5% being a high GDP growth number. And that's because in the past, it's all about urbanization, growth, consumption, big spending on infrastructure. And I think that's more or less the past now. If you look at more recent years, all the policies has been around stabilizing the property market. It's not about really sparkle any new growth or sparkle any sort of huge new things in any sector. It's about stabilizing, staying resilient, and self-reliance. And this is not just because of the new waves of the US tariff. This has been a broad strategic reset, I think. And the China's focus has been a lot more on self-reliance. You think about them doubling down on their domestic production in green technology, AI, semiconductors. I think the game of being more insulated and self-reliance has been there for many years. But if you look at today, the trade dynamics with the US, we all know that China export a lot more to US than it imports. So from that standpoint, you might argue that, China is more or less more insulated, or arguably easier for China to pivot, at least in certain sectors, than US. But this is not about just the trade balance. It's about the interdependence on sectors that represent strategic value and high value goods and services. And so I think in this environment, even if I think about, US is pausing on the rest of the countries and the rhetoric is still pretty much escalating with China, but global supply chain isn't really separated. It's deeply entangled. So it's never a one-way impact from China and US.
So with all of that in the back of our minds, right, and the market volatilities that we've seen, what are you telling your clients at the moment?
I think we're definitely reiterate that we're not in a prediction business. We're in a observing business. I think what we are saying or seeing is that we are navigating a structurally different world dynamic. And I think times like this is really times when your strategy and your temperament gets really tested. I think it's a time where you look at what you have owned, you ask yourself questions of what you own, why you own them, can they resist shocks, can they adapt, reprice, pivot? And are you looking for businesses that's got pricing power, that's got the balance sheet? And I think also importantly, I think stay humble really, because we can't all overnight become an expert on tariff, expert on geopolitics. And we are actually navigating an extremely complex situation when it comes to trade, when it comes to policy, and when it comes to the biggest economies that in the world. So I think stay humble, because in situations like this, you would have actually a lot of opportunities come around. A lot of the high growth actually comes from times when the sentiment is extremely low. So I think this is a time that calls for really selective rather than aggressive. And I think we aim to do that. It's a time that calls for a steady hand and calm minds.
That is you, Lee, there from Blackmore Capital. Don't forget, if you enjoy the podcast, give it a review or a rating on LinkedIn. You can do it on LinkedIn, but you can also do it on Apple Podcasts. And
this SBS On the Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.